Hey everyone, here's a quick breakdown of what's going on with interest rates, mortgage rates, how bonds, and even tariffs factor in. So the Federal Reserve has paused rate hikes for now after aggressively raising rates over the past 2 years to combat with inflation. They're closely monitoring economic data like job growth, consumer spending, and inflation trends to decide what's next. There's talks of possible rate cuts later this year, but that's going to depend on whether inflation continues to actually cool or not. Mortgage rates, now they don't necessarily follow the Fed rate directly. They're more caught up and tied to the 10-year Treasury yield. Right now, we're seeing mortgage rates hover between 6.5%, 7%, and that depends entirely on the borrower profile. The bond market, though, plays a major role. So when investors feel confident, they will pull money out of bonds, pushing yields up and mortgage rates higher. So in times of uncertainty, money moves back into bonds, which can bring rates down. Now, tariffs, they also add a little pressure. When tariffs are introduced or increased, they raise cost on goods, potentially reigniting inflation, which could lead the Feds to keep rates elevated. So where are we headed? Unless inflation comes down faster and the global economic picture stabilizes, rates are likely to stay higher for a little bit longer. It's probably wise to plan for a market where borrowing costs remain elevated and make decisions on today's numbers. If you guys have questions on this, feel free to reach out. I appreciate you listening. Thanks.